Hey, everybody, this is Lorillia. Welcome to another episode of the Never Lose a Deal podcast. This podcast is for investors who are looking to leverage different forms of capital and financing to be able to expand their real estate portfolio. And so today's topic, we're talking about leveraging debt, the cheat code of the wealthy. Now, I thought this would be a very interesting topic because I started to. Um, have a few conversations with some attendees who are going to be joining me for a workshop here locally in New Jersey. And in that workshop, I will be talking about different ways that real estate investors can fund their deals using different forms of financing. And so that led me to today's topic about leveraging debt and why it's the cheat code of the wealthy. Now, I want to preface this by saying, warning, um, this conversation is really for a particular person. And when I say person, I mean in terms of exposure that you have to certain conversations. This is not for the person who is new to real estate. One thing about the internet, and I've noticed in the past couple of years, we a lot of times we have people who are not well studied, definitely not well educated in some things, and really don't have the experience in terms of the practical. And so it's easy for topics to be taken and then misconstrued and then give it to the masses. One thing about the Never Lose a Deal podcast, that's never my intention here. So I never want to have you to think that the content that I'm sharing with you is from a salacious standpoint. So I say that to say the information that I'm going to talk about today is not for the new investor. If the word debt triggers you, that right there, if it gives you a funny feeling in your body, if you start to have feelings about what you don't like about debt, what debt did to you, how it messed up your life, maybe you have stories about, accumulated debt that you have taken on and you still haven't got over those traumas, then this conversation is not for you. Because by no means am I saying that this is a shortcut. And that's why it's a tool of the wealthy. Now, of course, there are many definitions of what constitute a person to be wealthy. I'm going to leave that up to you. This is not to unpack what wealth is, but this is what I will say. A lot of the people that I work when it comes to assisting them with getting funding, getting financing to expand their real estate portfolio, they are not new to real estate. I say that to say when it comes to leveraging debt, they are very open to leveraging debt. And so, why is that so, Lorillia? Why is it the cheat code of the wealthy? Well, it's the cheat code of the wealthy because leveraging debt is not taxed by the US tax code. So, real estate investors or high income individuals who are looking to lower their tax liability, they will look at real estate as one of the vehicles to lower their tax liability. With that, being the case, what happens is that when an investor takes on debt, what happens is that it triggers a few things. It triggers their ability now, especially if it's a multifamily, it triggers their ability to be able to write off the depreciation that is going to take place once they buy that asset. So if you have seen my other videos where I talked about buying multifamilies here in the tri-state area, New York, New Jersey, and Connecticut. I showed you a lot of those values are easy over $500,000. Well, one may say, well, who are buying those properties? Well, there are investors as well as high income individuals who are buying those properties because they understand that that is a way for them to lower their tax liability by becoming an investor. So when I say about using 20% to be able to put down on a property. I showed you those numbers. You got 500K asset that you're looking to buy. You put 20% down, you at 100K. Well, one may say, well, who has 100K? No one has that much money. Well, no, the people that don't have that much money. Those are the investors that That's not the full scheme of the real estate landscape. So that's why I said this conversation is not for the person who is trying to scrape up all their nickels and dimes. And by no means, I'm not trying to make fun of those individuals. But this is not the conversation for those who are new to real estate, don't have that much money for real estate, and really trying to find their way. It's for the individual who maybe consider a high income. Now, there is there everything has its own context. What is high income? Only an individual will know if they are high income. A lot of times it's someone who makes over six figures who knows that their taxable liability in terms of earned income is going to be taxed at a high rate. That is the definition of what some individuals consider high income. That all depends on when you take into account taxes. Are you single? Are you married? Do you have kids? Whatever the case may be. But starting right there, a high income individual is someone that knows that their salary is going to be taxed at the highest rate. What is the highest rate? The highest rate to get taxed on is earned income. So those individuals are looking for ways to lower their tax liability. Hence, that is why real estate may be the vehicle that they use. So going back to the example that I gave about a person buying an investment property, it triggers two things. They bought the property, it's a multifamily. They triggered the ability to take depreciation on that asset. I'm not going to go into the different depreciation methods they can choose, but they get to write it off with depreciation. Number two, the debt that they taken on to be able to buy that asset is a write off too. So when you take into account, you got the depreciation, you have the financing that's being used and leverage. Now that lowers the amount of income that is going to be generated from the property. Now, I'm doing very top level numbers. Of course, there's more numbers to take into account, but just using those two things that I talked about, depreciation and financing, that creates what's considered phantom income. That is income that an investor knows that they're able to realize as part of the wealth and equity that they are going to be um, uh, looking at and on a future date, because they know that that phantom income is not going to get taxed. So when they know that that income is not going to be taxed because now they've bought a real estate asset, they're generating income, they're taking the write off of the depreciation, they're taking the write off of the financing. Now that lowers their tax liability. Remember, I said now everything has context to it. Only an individual will know if they are in a high tax bracket. They would know that. So the investors that I work with or the salary individuals that I work with do consider themselves in the tax bracket of I have a high income, meaning I am being taxed at the highest rate that that is in the US tax code, and I'm looking to lower it. And so I am open to leveraging debt. They're open to leveraging debt. And so that's why I titled this video that leveraging debt is a cheat code to the wealthy, because it is a way that they are going to leverage it to be able to buy assets. When you buy assets, those assets allow you to now be able to write it off on your taxes. Now, of course, I'm just talking about from the standpoint of taxes, the cheat code of the wealthy when it comes to taxes. We still haven't touched on the equity that can be built up. Even though I touched on it with phantom income, we're still not talking about the retirement that one can look forward to. But these are just some of the few things. For example, recently talking to an investor here in my market. Um, they live in New Jersey, work in New York City, has, once again, high income job, they're not scraping pennies, they're not looking to get rich off of real estate. They are already established. They're an established professional. On top of, they also own real estate. They are very aggressive with buying more properties because they know and they have seen how their tax liability is being lowered. They are now being able to leverage those things because they want to be very aggressive with their retirement. They're in their 40s. They know they're close to retirement. They're not depending on the tax return. I mean, the stock market. So they wanted to diversify their retirement contributions. So they're being very aggressive. They're open to leveraging debt. So I say this to say, when it comes to the leveraging debt conversation, you need to know who you are as an individual. That's why I always say here on the Never Lose a Deal podcast, is conversations that I have here are not for the person who is trying to get rich off of a credit card and then just so happen to buy real estate. It has its place. There's a lot of people online who are sharing that information here, but I do find that a lot of people try to, massage the information that I share here with their situation. And I always say it's not going to work because I'm not talking to the person who is new to real estate or who feels like money is this mysterious thing and, there's a mysterious banker and entities who are keeping me away from the information. I did a video about that last week. Wasn't a podcast episode, but it was a video on my YouTube channel for those who are listening, where I talked about gatekeeping is really a mental construct. It's not real. There's no entities or individuals who are trying to keep you from information. Individuals who buy into that whole gatekeeping analogy are really individuals who are not well read. They're not well read. They're not well studied. And a lot of times they're looking to get their information from sound bites off the internet. And so that's why I said clients that I work with, when I look at, I started talking about leveraging debt and and pairing it with real estate. I've been talking about it since 2017 or 2018. For those who want the receipts, you can go to my YouTube channel and you will find the receipts of me saying the same thing for over 5 years. With that being said, when I look at the data of those who I have successfully worked with and continue to work with, were the individuals who were working professionals or who were full-time investors who were currently already doing real estate and were looking for alternative ways to be able to expand their funding toolbox. Those really were the 20%. When they say 80% of your results is from 20% of what you do, those were the 20% of the makeup of the people who had the best results. Now, did I have a few who came in and had never did real estate, and I was successful with helping those as well. But the one thing that I noticed, even with those individuals who were new to real estate, and I have those testimonials here on my YouTube channel if you're watching on YouTube, One thing that I noticed, they were working professionals. They were working professionals. So this is what I know. I have never really worked with the downtrodden. And then I hate to say it that way, but the reason why I say that, I really, my message and my information I share is not for the person who is looking to get rich off a credit card in some way. Do the same thing with real estate. And if you understand that one is liquid and the other one is illiquid, I'd like to use it as, if you think about chemistry, if you take the molecular structure of vinegar and you mix it with the molecular structure of baking soda. Um, if you use too much of both of them, you're going to get an explosion. Can they both be mixed? Yes. But using too much of one or the other is going to cause a very big explosion. That's the same way with leveraging credit when it comes to credit cards, because that's usually just the conversation when people on the internet talk about, leveraging credit or debt. They're really just talking credit cards. And then you pair it with real estate. The molecular structure of the two are different. And they are not if they are not being used properly, they can explode. And that's what a lot of people don't know. But once again, this is Lorillia. Like I said, if you're in the New Jersey area and you want to learn more about the workshop that I'm doing, go to www.neverloseadealevents.com. I should have had it on the ticker here scrolling, but if you go to the show notes, you'll learn more about it. It's www.neverloseadealevents.com. Like I said, it's a high level conversation. This is not a how to rebuild your credit to get credit cards and to eventually buy real estate. That's not what this is. This is for real estate investors who are currently buying deals, who want to buy deals. I've told them, bring your deals, because the name of the workshop is Funding Flow to Deal Flow. And we'll be talking about ways that they can expand their portfolio using the different forms of financing. And I want to be able to show them that. So, once again, this is Lorillia. For those who are watching on YouTube, please subscribe, leave a comment below. And if you're listening on one of the podcasting platforms, please rate and subscribe. I forget what you do on platforms. Yeah, I think that's what you do. But anyway, I will see you in the next episode. And until the next time, thank you for joining me.